How do you pay taxes in retirement? Is there a best way to pay taxes? This is a basic but critical question for retirees. While working, taxes are pretty simple and straightforward. Most workers withhold more or less the right amount directly from their paycheck, and this often takes care of all of the tax they need to pay in by tax time. But with no paycheck in retirement, how do you pay the taxes you need to when you need to? Step number one, you need to have some kind of way of projecting out at the beginning of the year how much you will actually owe in taxes. Most of your income should be fairly forecastable. Social Security, pension, and annuity payments are known at the beginning of the year. Dividends and interest can be projected out within a fairly tight band. Then beyond that, you just need to project out how much you will need to take from other accounts to fill in your remaining income need. I'd recommend doing this projection at the beginning of the year because, as we'll show, it will make everything a whole heck of a lot easier as we go into the next few steps. Again, you don't need to be exact here. We just need to be within the ballpark. Once we have this projection, we need to have a way of estimating tax liabilities. Now, someone who deeply understands the tax code can estimate tax liabilities by hand, but this is needlessly difficult. I would highly recommend finding a software solution that can help, whether this is something like TurboTax or some free online solution. This is also something you should look to your advisor or CPA to do for you. Once we have a good estimate of our tax liability, there are a few options we have for actually paying the taxes we owe. Now, the US operates on a pay-as-you-go system. This means that in general, when the income is earned, the IRS wants you to pay taxes. Now, when I say income earned, I really mean when you create a taxable event, whether that be a withdrawal or capital gain event. Now, there are two ways to pay taxes: estimated payments or withholdings. Now, even though these are two avenues for paying the same taxes owed, these two methods have some very distinct differences, and we'll go over both in depth. Withholdings will be most similar to how you pay taxes while working. You received certain income and withheld a portion of that income off the top, which went straight to taxes. The biggest difference between these two methods is that when you make estimated tax payments, you need to make payments on a quarterly basis, and they need to be timely, meaning the right amount needs to be paid each quarter, or you will end up with underpayment penalties. Withholdings can be done at any point throughout the year and be considered timely regardless of the timing of that payment. Now, an important trick that many retirees are unaware of is that you can actually withhold from Roth distributions. Roth distributions are non-taxable events, yet you can still withhold from them. This can be quite important at year-end, as we'll talk about. Just as an asterisk, however, some custodians, for whatever reason, may not allow you to withhold from Roth distributions, so be sure to check with your custodian. Now, before getting in-depth into each of these payment methods, let's discuss why we need to pay our taxes on time in the first place, and that would be to avoid underpayment penalties. If the IRS deems that you didn't pay the right amount of tax on the right timeline, they may levy underpayment penalties against you. Right now, the interest levied on underpayment penalties is a 7% annual interest compounded daily. This is high enough where the interest charge on underpayment penalties is higher than any safe interest rate you can earn, meaning you are losing money if you are paying these penalties. So how do we avoid underpayment penalties? There are two rules that if we follow, we will be in the clear, and these are referred to as safe harbor rules. First, we can pay at least 90% of the current year's tax liability. So just because we owe a little bit of tax on April 15th does not mean that we will have underpayment penalties. The government gives you some leeway. Say your tax bill for the year was $20,000. If you paid in at least $18,000 through withholdings, you're 100% in the clear. If you paid in $18,000 in estimated tax payments in a timely manner, you're in the clear. An example of paying in a timely manner would be splitting evenly throughout the year your given tax liability, or $4,500 each quarter in this example. In both cases, you can pay the remaining $2,000 balance at tax day and you are all good. The other method you can use is you can pay 100% of last year's tax liability. This is generally preferred when last year's tax liability was smaller than this year's will be. Note, you have to pay 110% if last year's income was above a certain threshold. Again, we'll go through additional examples of what this looks like. So now that we have a basic understanding of underpayment penalties and how to avoid them, let's talk about tax payment methods. By a long shot, the simplest way to pay retirement taxes is through withholdings. You earn a certain income or take a certain withdrawal from your accounts, and a portion of that income is withheld back and sent directly to the IRS on your behalf. Withholdings can be done on withdrawals from IRA accounts, Social Security income, or pension and annuity payments. The reason this is the simplest method is that you can withhold at any point throughout the year, and it is deemed to be timely. So let's go through a very extreme example. Say you are over 59 and a half and on January 1st, you want to do a big Roth conversion of $300,000, which will cause you to owe $65,000 in taxes. You could initiate the $235,000 net of tax conversion on January 1st and wait the entire year until December 31st. Then on December 31st, you could initiate the second half of this conversion, or rather this would be a distribution of $65,000. You can then designate to withhold all of that $65,000 to taxes, and you are completely fine. And your payments would be considered timely because they are done through withholdings. In fact, there's another way you could handle this even. You could initiate the full $300,000 conversion on January 1st, and then at the end of the year, do a $65,000 Roth distribution and withhold that full distribution for taxes. Both of these methods work and are considered timely again because they are done via withholdings. And this is the main reason why withholdings are much simpler. Timing doesn't matter. Withholding money from a distribution can be done a few different ways. For most tech-savvy individuals, this can all be done online when submitting a one-time or regular distribution. It can also be done via paper forms as shown on the screen. Every custodian's forms will look slightly different, but this will give you the broad strokes. Withholdings can also be done from other income streams like Social Security. Specifically for Social Security, you would fill out Form W4V and choose the preset withholding amount. For pension and annuity payments, the provider will have their own documents that you can request that will look similar. Now, there is a problem with withholdings that some of you may have picked up on if you've watched some of our other safeguard videos. Although withholdings are by far the simplest way to pay retirement taxes, they're often not the best way to pay taxes. Generally speaking, a retiree has 3 tax buckets they can utilize in retirement. They have their retirement-specific accounts, like tax-deferred accounts, which would be traditional IRAs, 401ks, 403bs, and so on. They also have their tax-free accounts, like Roth IRAs. And then many retirees have taxable accounts, like joint, trust, or brokerage accounts. Generally speaking, outside of specific situations, most retirees will want to exhaust their taxable accounts first, and there are a couple of reasons for this. First, by living off your taxable account first, you're able to keep your income quite low, which is beneficial for things like Affordable Care Act subsidies, but also allows you extra space to perform things like Roth conversions earlier in retirement. Second, a taxable account is a certified leaky bucket. All interest, dividends, and gains you realize in this account are taxable to you on an annual basis. Because of this, your taxable account will grow at an objectively slower rate because there are taxes constantly slowing the growth of this account. Think about this in the case of dividends or interest. You earn interest, you pay taxes on the interest, and now you have less earning interest for you going forward. This issue compounds each and every year and can make a huge difference in the long run. In the upper right-hand corner, I'll link to a video that explains this table and dynamic more in depth. Okay, so if paying taxes from a taxable account is optimal, how do we do it? Well, this comes with a little bit more complexity. We now enter into the world of estimated tax payments. As mentioned before, when making estimated payments, you need to do so on a quarterly basis to be considered timely. Here, timing matters greatly. You can't just make one big tax payment at year end like withholdings. On the screen, I have each payment period listed as well as the due date. Keep in mind these due dates can change by a couple of days year to year if they fall on a weekend. Now, the actual paying of estimated taxes is quite simple. The easiest avenue is going right to the IRS website and clicking the Direct Pay tab. Just make sure the payment URL has a .gov at the end of it. Here you can choose a reason for payment and the tax period the payment applies to. At the end, you will have the option to email yourself a receipt for additional proof come tax time. You can also mail in a check for estimated payments as well. Typically, your CPA will prepare an estimated tax receipt, and that will include the address that you must mail your payment to. But now let's go through some varying situations to explain how to properly make these estimated tax payments in accordance to the safe harbor guidelines. First, let's say we have an individual here that had $100,000 of AGI last year, which brought their tax bill to $11,000. This year's AGI will be much higher, but for the sake of this scenario, let's say we don't know exactly how much higher. Well, remember that one of the safe harbor rules we can meet is paying in 100% of last year's taxes broken up into quarterly payments. So pretty simply here, if we take $11,000 and divide it by 4, we can pay this amount each quarter and be completely fine. It doesn't really matter if this year's tax bill is $15,000 or $50,000. We will not owe penalties because we are paying on a timely manner and we met the safe harbor rule. Let's use a similar situation but raise last year's AGI from $100,000 to $175,000. The same principle and rule as the last scenario still applies. The only thing that changes here is that we'll have to pay in a little bit more based on last year's tax liability. Because we are over $150,000 of AGI last year, we need to pay in 110% of last year's liability, or $27.5 at each quarterly deadline. Again, it doesn't matter how big this year's tax bill is, because we met those safe harbor requirements and did so on a timely basis. So anytime you have a situation where your tax bill this year will be larger than last year's tax bill, the estimated tax payments going forward are quite straightforward. You really don't need to do anything but follow the guidelines based on last year's numbers and do so evenly. But what if your tax bill this year is lower? Well, you can still follow the guidelines based on last year, but the problem with this is that you're going to overpay taxes and get a refund come tax time. Although many people like getting a refund, all it is an interest-free loan to the government. We generally don't want a refund. So this is the situation we are dealing with on the screen. Last year's taxes were $20,300. This year's taxes will only be $10,700 after showing far less income. So now the rule that comes into play is that we need to pay at least 90% of this year's tax liability evenly over the 4 quarters. This will require us to be able to forecast this year's tax liability somewhat accurately. It is generally best to slightly overestimate here, and then if numbers come in lower, you can always make a smaller Q4 payment. But assuming we can accurately forecast our numbers, we can just make a 22.5% contribution each quarter based on the annual tax liability. 22.5% times 4 is 90%, if you're wondering why there's a weird percentage amount. Now, invariably, some of you will be in the infrequent situation of having lower taxes this year than last year, but also having some very variable income. For instance, maybe there is a large capital gain bill mid-year that throws off your annual projections for that year. Know that there is an additional option that you have, and that's Form 2210. We won't be going in depth into filling out Form 2210 as it's far less common, but if you have variable income, estimated taxes become a bit trickier. I have a snapshot of the form on the screen, but effectively what happens with filling out this form is that each quarter you annualize out your income and makes tax payments based on that annualization. So let's say you have a big taxable event in the first quarter and no events in Q2 and Q3. Annualizing out your first quarter's income could require you to make a big tax payment in Q1, and then much smaller, if maybe even no payments in Q2 and Q3. The idea here is that you don't know what your income will actually be, so you make best guesses based on naive annualization methods. Again, this can be filled out and done on your own, but based on the complexity, I'd recommend working with a tax professional here. This situation really only comes up if your income is variable and this year's tax bill is smaller than last year's. If your income is variable and bigger than last year's, just use the 100 or 110% method that we showed earlier. Here's a written simplification of the rules. I'll leave this up on the screen for a little bit for those of you that want to read through for maximum understanding here. The first time reading through estimated payment rules, you might find your head spinning. Hopefully after going through some of these examples, we gave a clear decision tree for how to handle certain situations and payments going forward. Often a family will find themselves in a situation where they are managing both withholdings and estimated payments. Withholdings are assumed to be paid evenly throughout the year. So if you withheld $10,000 this year, it will be equivalent to making 4 $2,500 quarterly payments. Don't be someone who pays a bunch of needless underpayment penalties in retirement. The taxes you owe are already enough. If you're looking to learn more about the first account that you should pull from in retirement and also pay taxes from, click on one of these videos right here where we dive into why your taxable account should be the first account you pull from and why it's your worst growing account. Thanks for watching, and always remember, you don't need more money, you need a better plan. Look forward to seeing you in the next video.